Good morning, ladies and gentlemen. As always, we start with our friend, the bond market, which is doing exactly as we said it would do. 2.99 yield in 5-year notes held beautifully, and now we're probably going to retrace back down to something like 288, 286. But we think the trend now is very much set for at some stage a hard break of that 3 level, and after that you know what happens, because we showed you last week the market goes a lot higher, probably 50 basis points. So much the same picture is in the 10-year, less so than in the 5-year, and we'll look at the repercussions on XLF. We are probably, as you can see here, we have the stochastics, the MACD in this case, turning back up. So we'll, this is what I said in the 5-year, we'll have a brief period of possibly higher prices above 119, which will give us a great opportunity to reset some shorts and be more aggressive with put spreads, because it is now painfully obvious that the Fed at some stage is going to lose control. And when that happens, that will be the trigger for an aggressive risk-on move, i.e. Bond yields go a lot higher, and then an aggressive risk-off move as people actually realize that it's not so good to have rates way up, sort of real 1% when things are very bad, are turning bad for the economy, and that could actually kill it. So we're looking for overkill from the Fed, we're looking for overkill from the bond market, and so exciting times in Q4. But basically 10-year, if we get anywhere between 119.08 and 119.16, we are looking for to put on some large bearish positions in the 10-year note. 119.08 to 119.16, 18 is the level that we want to purchase put spreads aggressively. Why don't we think that the 10-year note can go straight away higher in yield? Well, because the Bund is not ready to do so, and there is so much liquidity sloshing out of Europe coming into the US that without the Bund being able to participate to some extent, the 10-year note is very much stuck or supported at these yield levels. It's not going to break 3 in a hurry without the Bund giving it some help. And as you can see from a weekly, I mean, it got to exactly where we told you would get, the 10 basis points from the break, and this is it. The the Bollinger Bands on the weeklies are restricting. We would bet that it would probably trade 38 before it trades to new highs. So another at least 2 or 3 weeks of inaction in Bunds consolidation, and then the same in the 10-year note. That is why we don't think anything much is going to happen, and that we are not ready to attack the 10-year note now in the States. We think that people will get squeezed out of their positions at some stage. They'll pay 119.16, and that is where we want to be positioned. This one is the interesting one still, the spread between the 10-year in Germany and the 10-year in the US. As you can see, it's just stuck at this top position, breaks it for a day, comes right back. This 260 level is extremely important. I would want to see at least 2 or 3 closes above this 260 level, sustained closes above it, to say that the market is ready to go higher. But the technical picture in the Bunds tells me that it's not ready to go higher, and without Bunds trending higher, i.e. being able to go at least 20 basis points, we don't think the 10-year note will be able to do the 30 to 40 basis points that we think it has in it at some stage in quarter four. We have shown you this dial before, and we will keep on showing it to you because it's the distillation of all the spread work that we do, and it's the mathematical expression of those spreads. Without this risk dial going to at least zero, the equity market is in a risk-on phase. Full stop. No more to be said about it. Nothing more to think. Look at the score. We are in the 80s or 90s out of 100. It's risk on. It's still risk on. There is absolutely no reason to think risk off is coming in the days ahead. None. All the spreads are indicated risk on. Stay with risk on and keep on buying the dip. And having said that about equities, let's have a look at what the dangers are and where they might go next. I mean, we've been saying for days and days and weeks now that basically the S&P is bounded by these moving averages on the bottom and the Bollinger Band on top, and it's just crawling in this channel. What does that tell us? That tells us that it will people are trying to buy the dip. It also means that it's not time yet to buy volatility. And finally, it tells us that the upside is very, very limited because, okay, now the upside is going to be 29.50-ish, probably, you know, around 55. And the bottom at the moment is just over 2900, where this moving average will come into. But the danger still is that we get at some stage, and when I'm not saying now, absolutely not now, we are more likely to keep on doing this for the time being. At some stage when we break this moving average, we will collapse down to this red moving average where things have always gone to before, and possibly below it, but certainly to it. And that is what the danger is in the background. But we have our triggers. We know what the triggers are. A close below this moving average on the weekly will trigger a big move down to this red one. For the time being, we are talking about 2900 to 2950, 55 as being the range. The most important thing now to look at actually is not the SPY, but its components, because they are acting completely differently, and that will actually explain why we're getting this phenomenon and what in future might break it and give us an opportunity to make some real money on the downside. Before anybody thinks that I'm bearish, I told you a couple of weeks ago, buy the crap out of Nikkei call spreads, and here we are. Does this look like a bearish chart to you? Doesn't to me. It's going to above 25,000. So there's another, what, 3-4% in it. So keep that in mind. The Nikkei is leading this. There's money leaving Europe. It's leaving all kinds of other markets, and it's going in the Nikkei. So until the Nikkei stops going up, equities are going to be very well supported. There will be buy the dip moments, and dips will be bought. The Nikkei has to give us a reversal signal at some stage, or an exhaustion signal when it probably gets this line, which is above, 25,300, something like that. So a long way, another 1,200 points, another 3-4%. So the betting would be that actually the SPX gets to 2950 without a problem, rather than breaks this 2900 level that we just spoke about. But so that is the preface for what I'm going to show you now in the various sectors. So don't get bared up because I showed you some because I show you some potential very bearish action. It's gonna come, but it's gonna come many weeks from now. Exhibit A for the bears is actually Europe. I'm very afraid of Europe, not because I know that something is going to happen, but because I'm just afraid. I know that Europeans are very, very good at making amazing screw ups and not recognizing that they have made a screw up. And that is really the problem. It's the timing problem. They take an awful long time to put things right. They're not like Anglo-Saxons. They're not immediate. Europeans have a glass of wine, they go to sleep, they think about it for 2 years, and then they recognize they're in the shit. So when things go badly in Europe, they tend to go badly for an awfully long time. And as you know, DJT says, no good things happen below a negatively sloping 200-day moving average. This is your negatively sloping 200-day moving average, and this is why we keep on buying volatility in Europe and selling volatility in the States when it's trading at a negative level. To us, negative volatility in the US, in spread in the US and Europe, is just a gift. So that's it. Exhibit 1 for the bears. If Europe is showing a negatively sloped 200 MA above which you cannot go, the odds of a real move down at some stage keep on increasing. Exhibit 2 for the bears, and I'm trying to build a longer term picture here so you understand what I'm talking about, is actually this spread between SPY and DBC, the commodity sector. It's funny that really it's done nothing since Q2 of 2017. Okay, so that's 18 months of trading sideways in a roaring bull market for SPY. Okay, it's been a roaring bull market for SPY, and the spread against DBC, i.e. mere commodities, has done absolutely nothing. All it's done is flatten out the 200-day moving average, which to me is a bit of a bear signal. You know, pretty soon this 50 could crash through the 200, give another sell signal, and we could be going quite a bit lower. We could be going 10-15% lower. But that to me is something that I wouldn't be expecting. All the time in the spreads, I'm looking for things that I would not be expecting to be happening at this stage. And this is one of them. This to me also says that commodity prices and mainly energy will stay strong. And if they stay strong, we could have a repercussion in the bond market. My thesis basically has always remained the same. The only thing that kills stone dead an equity market is a bond market. The bond market rules, the bond market is the dog, the equity market is the tail. So if anything is going to happen to equities, is going to be because bonds have decided that it should happen to equities. And this to me is an exhibit that something, if this now starts crashing through 14 and then goes down to 13, that will be my sign that the bonds cannot be far behind. And when bonds are not far behind, then all sorts of things can start happening in the sectors, and we'll have a look at those now. This is a very worrying chart for the bulls. This is XLF over SPY, so the financial sector as a proportion of the S&P. You know, we have been going nowhere since basically 2010. It is very, very interesting that the financial sector, which is a large component, the second largest component of the S&Ps, and probably the largest component of the Russell, cannot go any higher. It cannot lead S&Ps. So at best, it's performed the same after taking a humongous dump. I mean, don't forget, this is where it was before the crisis. This is where it was in 2007. And this is where it's now. I mean, you can see, so now it's not even 50% of what it was in 2007 and before. So to us, that is a worrying sign. And if we actually couple that with this chart, which we've shown you many times, and this is XLF basically with a plot against the difference in yield curve between overnight money, very short-term money, and 5-year notes. This is, to us, a very, very, very worrying signal. Why? Because banks are nothing but institutions which take very short-term money and transform it into lending at roughly the 5-year period. That's what banks are. Bank profitability is driven by the shape of the yield curve. If the yield curve is flat or negative between overnight money and 5-year, you get no profitability for the banks. Look at what's happened in Europe. Look at how weak the equity market's been in Europe. Why? Because the banks can't make any money. The banks are a drag on the whole economy. They're unwilling to lend. And this is what could happen to the States. If you watch Ray Dalio, and you can Google the videos, he is absolutely right. The whole of the rally is a liquidity event. S&Ps are nothing but liquidity events. So you have to look for what is going to kill the liquidity event. And that could be a move into negative territory for the 5-year note against the very short-term overnight money. Not seeing it yet, but if that were to happen, you would have these jaws close at a massive rate by a fall in XLF. I told you many weeks ago that XLF was now probably dead money. This is actually the chart of XLF by itself, and it's a worrying chart. Not now, because let's face it, we've been going down for 1, 2, 3, 4, 5, 6 days on the trot. Chances are that at some stage it rallies, and it rallies to at least the 200-day moving average that it's breached. So back up towards 28, 28.10. So that would give us like a 2% rally in a sector which is a 20% component of the S&P. So that will give us at least 10 points all by itself in the S&Ps. So that could easily take us to new highs if the other sectors participate. So I'm not arguing for an immediate fall in the S&Ps. What I'm arguing is for very, very limited upside in the S&Ps. And because this sector is just not allowing the S&Ps to go higher, we would have to see something very, very different, and we would have to understand why it's different for us to change our mind and see significant upside in the S&Ps. And you all know what markets are like. The market will remain patient, will remain patient, will remain patient. People will lose patience, and they will get longer and longer and longer, and then you're going to have a humongous rug pull at some stage. Probably exactly when they expect it to start going up, and that is in the last 30 days of the year when everybody's bullsed up and is looking for the Santa rally. So we could actually get a reverse Santa rally, a Santa dump this year in December. That is more likely than a sustained rally, especially in XLF, which, let's face it, is 20% of the S&P. How is the S&P going to go higher when you have a flat 200-day moving average and the market is now trading below it? This is going to take some more weeks, but in, say, a month's time, if this moving average starts to turn down, the 200-day moving average, we will be very, very happy to start speculating on the downside in the S&Ps. Why do I say that we have a lot of time left to prepare? Well, because the financials, the regional banks, are the largest component in IWM, which is the Russell. completely different chart, right? We still have a very nicely positively sloped 200-day moving average, slowly catching up to the market. We are having a wonderful, nice consolidation here at the top. This is not very bearish. It's holding the 100-day moving average. So it's going to take quite some time before it's ready to break the 200-day moving average. And if that's the case, XLF will not go that much lower. So I'm absolutely not concerned that what I'm telling you is going to happen in the next month. I think it's going to happen within 3 to 4 months. But that is very interesting because you want to start getting on some very, very cheap long-term put spreads and doing some calendar spreads, i.e. selling stuff for a couple of months and buying stuff for 3 to 6 months. So the sector actually which has been more or less taking the strain from XLF has had to be XLK. But if you look at this chart of XLK, how much higher can it go? Can it go a couple of percent? Sure. But this is to me, this is a wedge. This is a market which is not going to be explosive on the upside. And if the two largest components of the S&P, which, what are we talking about? We're talking about XLK and XLF. One of them is on the cusps of a bear market, or at least doing zip, and the other one has got very, very limited upside. You're talking about a contract which overall cannot rally more than 1% a week, and that is all you're gonna get. You're getting into the terminal phase, the wedging, the people getting longer and longer at bad levels. Dangerous position for the medium term. I want to show you VTI, which is the total stock market. It's all the shares, everything. So it's the S&Ps, it's the Nasdaq, it's the Russell, it's everything. Okay. What to say? Is this going higher? You know, can it go 2% higher? Sure. Can it go 2% lower? Yes. It's stuck. It's stuck. It's not the time to buy volatility, and it's not the time to get short and bearish of the market. There is nothing bearish at the moment, but what we have is warning signals that at some stage, when we get a breakout in bonds, the traditional risk-on effect will be very muted, and then it will very quickly turn into a risk-off moment. And finally, some words about the dollar, because that's the only other thing that we think is still interesting here. Well, it never got to our level 93.63. But it got awfully close, and as you can see, there is absolutely no chance it's going to break it anytime soon. We have now some bullish crossover signals in the MACD. The stochastic has been bullish for days. Still not in a position to break 96.50. We would now be two-way traders. We've been better buyers as it approached 93.63. We will be now two-way traders. We don't think the market is ready to break 96.50, so we are still in a position that not a lot should happen to the dollar. And this actually ties in with what we said earlier about the bond market. Certainly another 2-3 weeks of consolidation. What we said about the spread between bonds and 10-year notes, and what we said about the stock market, sideways to up, in well supported with people buying the dips, much the same as the dollar. At some stage the dollar will make a big break, and when that big break comes, there will be volatility spillovers into equities, but that time is just not now. And with that, we have our biases. So 113.05 we said short, 113.16 stop. Yes, and now we can actually say 119.16 in 10-year notes is where you want to basically get some very nice put spreads, and we will tweet to you which ones those should be and for how long. Bunds and bobbles, we keep on telling you that they are untradeable because of Italy. Every time the Italian bond has a nightmare, what happens is they buy up bunds like crazy. But we were looking for 10 basis points. Got it. Thank you very much. Out. We're probably looking for another 5 basis points lower than here, but that is, our positions are minimal, simply because we recognize that trading Germany is very, very hard at the moment until it starts trending, until there is a resolution. So we are not very happy trading. Very overextended SPX, as we said. 29.05, 28.95 is the buy the dip level. Crawling towards the top Bollinger Bands, which now will come in 29.50-ish. Very happy to short it up there. Very happy to short. NQ, you know, it's wedging. It's doing nothing wrong, as we can keep on saying. No confirmation, none whatsoever. But it keeps on looking vulnerable. Every week that passes here and it cannot gain momentum is another week that I think I don't want to be long of NQ. Certainly not up here. XLF to us is the canary in the coal mine. It's just telling us, well, you know what it's telling us. I've shown it to you. It's not a bull market. XLF is making sure that it's not a bull market, and that is because of the behavior of the bonds. Volatility, you just can't be long of it for any length of time, simply because the board is very steep. In the next 2 weeks, the front month will fall. If nothing changes, the front month will fall by 10 ticks to 15 ticks per trading day. Every day the front month is going to be 10 or 15 ticks lower, and that will bring the whole curve lower with it. So because of the steepness of the board, you just can't buy it. To us, US volatility is a sell against European volatility. This is where we fear bad things might happen. It might not happen for a week, it might not happen for a month, but it's going to happen to us, we think at some stage. We are avoiding European equities simply because we recognize the ability of Europeans to screw things up. The dollar, still stuck in this range. Better sellers at 96.50. Great buyers of volatility at 93.63. 3-month straddles. Nikkei, still long call spreads. The Nikkei is still to us going to 25,500-ish. And we think that that level will probably coincide with a pretty good top in SPX as well. Thank you very much. Have a great weekend, and tweet you on Monday.